Chinese are selling treasuries and they're selling dollars to buy commodities. The problem is that the central banks try to use interest rates to manage the rate of inflation. Gibson's paradox, in other words, they've ignored the evidence because they can't understand why, and basically they've just screwed up the whole system. But basically the rate is closer to 10%, and it's been running like that for the last 10 years. 10%, 10%, 10%, 10%. Not 2%. 2% is a gold sort figure, as sound money is representative of the prices of everything else, of all the commodities. So if you get rising interest rates, which is inevitably going to happen when the dollar runs into a crisis, gold is not going to go down. Gold is going to go up with the interest rates. Now, it sounds counterintuitive, but this is actually what happened in the 1970s, and it's actually what happened the whole way through from 1750 to 1970, which I demonstrated in one of the charts there. So the situation as far as commodities is concerned is that because gold is in effect representative of commodities, just that little bit in the middle which allows you to translate your production into your consumption. That's all it is. That is all monetary gold is. So you can see from that relationship between gold and the commodities, which are the feedstock for the things that you buy, they all move at the same time. So, and this is why, people say that the price of a toga, a good quality toga, is the same as a decent suit today. I mean, really what they're saying is that the purchasing power of gold stays roughly the same throughout the centuries, which is broadly true. I mean, there is some fluctuation, but nothing like the fluctuation we get with paper currencies. And this is why commodities are rising as far as people are concerned. They say, well, it's those damn Chinese, they're buying commodities. But actually, if you think on their strategy, what they're doing is they're dumping dollars for commodities. They can go out and buy commodities any time. But the reason that they have to do it now is because they got all these dollars and they can see that the dollars are going to lose purchasing power. So what do? You get rid of them now, is the answer. What do you get rid of them for? There's only one thing you can get rid of them for, and that is other commodities. So the Chinese are ahead of us all on this. And it will only be a matter of time, probably after a banking crisis, probably after the financial assets bubble has burst, when we suddenly say, we're losing money, our equities are going down, this is an absolute disaster. What do? I want to sell those equities, but what do I want to sell them for? What do I want to end up holding? Do I want dollars in the bank? Yeah. I don't want dollars in the bank. What else can I do? Commodities. And obviously what we do is we go for the one thing that represents those commodities, and that is commodity money, metallic money, gold and silver. So the Chinese, they don't need to buy gold. I know that for the very simple reason that they've accumulated all their gold. They haven't told us about it. I reckon they've got about 20,000 tons hidden from us, and that's the state. And bear in mind also that the Chinese people have got another 17,000 tons roughly. So you've got about 37 to 40,000 tons of gold in China between the state and its people. They don't need to buy gold. They've got all that. But what they want to do is they want to get rid of their dollars. So what do? They buy copper, they buy nickel, they buy zinc, they buy lead, they buy food, like lean hogs, they buy lumber, up 250% since March the 23rd, when the Fed turned around and said, deflation, forget it, we're going to print until the cows come home. Whatever it takes, we're going to print. That was March the 23rd, and since then lumber is up 250%.
Approaches.
One has got the problem, the other has got the solution. The US has the problem. It really does have a huge problem because not only do they not understand economics around at the Fed, but they're committed onto a course which they cannot get off. I mean, just imagine that the Fed turned around and said, printing money is not going to work. It's not working. We're just going to stand back and let you guys in the economy just sort it all out. They're stuck. They cannot do anything about it. And of course, as soon as the foreigners understand this, and remember the foreigners have got 21 trillion of securities at current valuations in the market. They have got a further 6 trillion of cash and short-term bills like T-bills and so on and so forth, which are not securities, but, sort of promises, if you like. So they've got 27 trillion of dollars, 6 of which is liquid. And your GDP last year, which is going to be more than the GDP this year, was 21 trillion. So they've got 125% of your GDP in realizable dollars. Are they going to sit there? No. The Chinese are already selling T-bills. They're already selling US treasuries. They're already selling other dollars. Now, this is not something that they really wanted to do, because remember that of their $3 trillion, they have lent over $1 trillion of those to all their client states, all the people who provide them with raw materials and things like that, and on the Silk Road routes. So the whole of sub-Saharan Africa owes money to China. What do they owe it in? Dollars. So if China's going to get paid back in dollars, its first default is it wants to see value in those dollars, because that is the whip hand it has over those countries. If you make the dollar zero, then they lose all that power. So this is not something that they actually want, but they've decided it is happening. And China, in effect, is triggering the nuclear option, the financial nuclear option, because it's got no alternative. It's been pushed into this situation because of the Fed's policies, which are destroying the purchasing power of the dollar.
Well, that's a rosy summation. I'm trying to decide which part of that beast to poke next. Oh, I know. One thing you didn't go into, but I'll bring it up. You mentioned interest rates have to increase. Okay, so you've got Jay Powell and the Fed saying on the one side, we're going to keep rates low for as far as we can see. Rates are going to be low. They're not going up. Yep. And you've got Alasdair Macleod saying they have to rise. That's one question. So what's why the difference? Number two is, if rates do go up, isn't another cataclysm of that is what it does to the solvency of all the sovereign states around the world who are carrying unheard of amounts of sovereign debt. So if you could first go, why the gap between low interest rates forever versus you say they have to rise?